So imagine you buy a multi-million-dollar house. You sign the papers, you walk through the front door, and, you generally expect the foundation to just stay put. You expect the walls to hold up the roof. You are buying a hard asset that is supposed to sit there and retain its value for decades.
Right. I mean, the reality of home ownership is usually just what? Patching a leak or painting a room. The actual structure itself is pretty permanent.
Exactly. But imagine buying that exact same mansion, and the moment you move in, the physical bricks start dissolving into thin air. Every 3 to 5 years, the entire house completely evaporates, and you have to rebuild the entire structure from scratch just to keep living in it.
Oh, wow. Yeah, that sounds like a nightmare.
And not only that, but the cost of the new bricks keeps skyrocketing. And literally every other person in your neighborhood is desperately trying to rebuild their evaporating houses faster than you are.
So you're basically just running on a treadmill that constantly speeds up. Like you're pouring all of your cash into simply maintaining the baseline.
Yeah, exactly. And welcome to today's deep dive, because that is exactly what we are talking about. It is August 4th, 2026, and we are looking at a company that is quite literally building the architecture of the future. But their bricks are evaporating.
Yeah, Space Exploration Technologies Corp., or, better known by its new NASDAQ Q ticker now, SBCX, they just dropped their inaugural Q2 earnings report as a public company.
And it is a staggering piece of financial literature.
Yeah.
I mean, we are looking at a $1.5 trillion conglomerate experiencing 92% year-over-year revenue growth. They absolutely crushed Wall Street estimates across the board.
Oh, totally crushed them.
Yet, despite those incredible top-line numbers, the stock dropped 5% in after-hours trading. So our mission today is to unpack this massive stack of financial and strategic research on SVCX to answer one really critical question for you. Is this company the ultimate insurmountable monopoly of the future? Or is it, a hyper-capital-intensive house of cards?
Right, because we are going to explore the hidden realities of their vertical integration and this, frankly, terrifying $18 billion financial black hole they've somehow opened up in a single quarter.
Yeah, and why traditional deep value investors are basically terrified of their entire business model.
Yeah.
But before we jump into the numbers, just a quick housekeeping note.
Sure.
The comprehensive research we are unpacking today is pulled from the latest deepvalues.ai agents. To access more advanced research, applications, and our latest Deep Value agents, we definitely welcome you to explore and join deepvalues.ai.
And if you want to track the total market temperature while we're doing this deep dive, you can actually search and download the iOS app, a Buffett indicator from the Apple App Store, or Bubble Watch from Google Play.
Exactly. And as always, just a reminder that all our analysis is based on publicly available sources and may be subject to revisions or different interpretations. All contents from this channel are for research and entertainment purposes only, and this does not constitute any investment or financial advice or service. So definitely conduct your own due diligence before making any investment or financial decisions.
Yeah, especially with an equity as volatile and, frankly, unprecedented as this one. You really have to do your homework.
Right. So let's look at how this company actually generates cash today. Because I feel like the general public perception is still mostly, oh, they launch rockets, right?
Oh, yeah, completely.
But looking at the top-line numbers from the agents, rockets aren't even the main driver anymore. So what does the actual revenue breakdown look like for Q2?
Well, the total revenue for the quarter came in at $7.814 billion, but the structure of that revenue is, it's entirely detached from legacy aerospace.
Yeah.
They've essentially segmented the business into three really distinct arms.
Okay, so what's the biggest one?
The primary cash engine right now is the connectivity segment, which encompasses Starlink. That alone brought in $3.83 billion. And that is up 66% from last year.
Wow, 66%. And what's interesting there, if you dig into the sources, is how the customer base itself is shifting. I mean, they are nearing 12 million global subscribers, but they aren't just selling satellite dishes to rural homeowners anymore.
No, not at all. They are moving so aggressively into the enterprise space.
Right. They are locking down these high-margin aviation contracts to provide in-flight Wi-Fi for major airlines like United and Lufthansa, alongside maritime contracts that now cover, I think it was over 150,000 commercial vessels.
Yeah, and those enterprise contracts are huge because they provide predictable, recurring revenue with significantly higher margins than just standard consumer subscriptions. But, the second segment is really what is driving the most aggressive growth.
The AI division, right?
Exactly, artificial intelligence. Following that massive $1.25 trillion integration with XAI, this division posted a 247% revenue surge, hitting $2.18 billion for the quarter.
Wait, okay, let's pause there. How does an AI division generate over $2 billion in a single quarter alongside a space company? Like, what are they actually selling to make that kind of cash?
Well, they are basically monetizing compute and intelligence at just an industrial scale. They are licensing their enterprise large language models to Fortune 500 companies, selling access to the Grok APIs for developers, and crucially, they are renting out massive amounts of raw computing power from their new Colossus supercomputer to external research labs.
So they're basically a hyperscale cloud provider now, too.
Basically, yeah.
Yeah,
Which brings us to the third segment, the legacy space division. This encompasses launch and the Dragon capsules, and that brought in 835 million.
right. Now, I was looking through the Falcon 9 flight logs for 2025 in the research, and I noticed something really bizarre about who they are actually launching these rockets for. Can you just run through those launch numbers real quick?
Yeah, it's fascinating. So out of 165 Falcon 9 launches in 2025, only 43 of them were for external fee-paying customers, like NASA or private telecom companies.
Right.
The remaining 122 launches were purely internal, just flying Starlink satellites into orbit for themselves.
So wait, the Space Launch Division isn't really a standalone commercial product anymore, is it? It's essentially an internal FedEx logistics wing that exists almost entirely just to build and maintain their own global telecom network in the sky.
That's exactly what it is. And that internal logistics wing is the foundation of what analysts call a closed-loop supply chain.
Which is pretty rare, right?
Oh, incredibly rare in aerospace. Look at traditional aerospace. It relies heavily on margin stacking.
Hmm.
A company like, say, Boeing or Lockheed Martin buys components from a subcontractor, right? And that subcontractor buys parts from another supplier. And everyone adds a 15% profit margin along the way.
So the final price tag is just bloated with everyone's markup.
Exactly. But SpaceX bypasses all of that by mastering reusable rockets. I mean, they're flying the same Falcon 9 first stage over 20 times. Now they have driven their own marginal cost to reach low Earth orbit down to under $15 million a flight.
Wow.
They own the rockets, they manufacture the satellites, and they own the consumer distribution network. Literally no competitor can mathematically match those unit economics.
Okay, so on paper, that sounds invincible. I mean, you have an impenetrable economic moat, total vertical integration, and 92% revenue growth. So why does the market react so negatively? If they own the entire supply chain, why did the stock drop to $118.14 in after-hours trading?
Well, the market got spooked by the sheer cost of keeping that massive machine running.
The CapEx.
Yes, the CapEx. Well, the top line is booming, and their net loss actually narrowed to a negative $541 million for the quarter. The real shock was buried in their capital expenditure. In Q2 alone, SpaceX deployed an extraordinary $18.369 billion in CapEx.
$18 billion in a single quarter.
In a single quarter, yes.
I mean, if you annualize that run rate, you are looking at over $73 billion a year in cash just going out the door for capital expenditures. Where on earth is all that money even going?
It's being poured into two really massive physical infrastructure projects. First, the rapid build-out of the Colossus AI data centers, which requires buying tens of thousands of highly advanced GPUs. And second, the ongoing developmental testing and manufacturing of the Starship launch vehicle.
And this goes right back to the evaporating mansion metaphor we started with. We have to look at the brutal physical realities of the technologies they're trying to dominate here. Let's start with Starlink and the physics of low Earth orbit. Sounds very futuristic, but space is just a highly corrosive environment.
It is. People forget that low Earth orbit is not a vacuum. There is actually atmospheric drag.
Right.
So satellites at that altitude require onboard propulsion just to maintain their position. And once they run out of their argon or krypton propellant, their orbits naturally decay. They literally fall back into the atmosphere and burn up. A standard Starlink satellite has a physical lifespan of about 5 years.
Meaning, this isn't like, laying a fiber optic cable in the ground where you dig a trench once and use it for 30 years.
No, not at all.
To maintain a network of thousands of satellites, you are forced into this perpetual cycle of replacement. You have to manufacture and launch hundreds of satellites every single month just to replace the ones that are currently turning into fireballs in the upper atmosphere.
Exactly. And the AI hardware side suffers from a very similar depreciation cycle, albeit governed by Moore's law and the rapid scaling of neural networks.
So they are buying chips that go bad, basically.
Basically, yeah. The silicon training clusters they are buying for tens of billions of dollars today will be effectively obsolete within 36 months. New chips just keep coming out with vastly superior processing power and thermal efficiency, meaning if you want to stay at the cutting edge of AI, you literally have to rip out the old data centers and rebuild them.
They are trapped in a brutal CapEx war then. They are fighting against legacy hyperscalers like Microsoft and Google. And when the entire tech industry is pushing data center spending towards $700 billion, you really can't afford to stop spending, can you?
No, you can't. And this is why institutional short sellers are terrified by this concept of maintenance capex. They are asking how the math of this business ever actually stabilizes.
Because if your core physical assets, your satellites and your supercomputers are turning into pumpkins every 3 to 5 years, you are never actually finished building the network.
Right. And this explains why SpaceX's free cash flow over the trailing 12 months is a staggering negative $14.5 billion. If the massive AI models trained at the Colossus facility fail to generate some sort of proprietary long-term software moat, those tens of billions spent on GPUs will transition into stranded assets.
Stranded assets, meaning hardware that serves no competitive purpose but still cost a fortune to buy.
Exactly.
So even with that terrifying cash burn rate,
Yeah.
they do still control 65% of all active satellites in orbit. They have immense power.
Yeah.
But digging deeper into the sources from the agents, there are some very acute, immediate vulnerabilities that threaten how the market values this company right now.
Yeah.
And the loudest ticking clock is happening in exactly 2 days.
Right. So on August 6th, 2026, the company faces its IPO lockup expiration.
And this isn't normal lockup, is it?
Well, no. Unlike traditional IPOs that use a simple 180-day cliff for all insiders, SpaceX adopted a pretty complex tiered structure to prevent a total market collapse. However, this specific date unlocks 911.5 million shares, making them eligible for public sale.
911 million shares. That represents a $100 billion wave of newly tradable equity, potentially flooding the NASDAQ. I mean, regardless of the underlying fundamentals of the business, basic supply and demand mechanics dictate that if early employees and venture capitalists decide to cash out even a fraction of those shares, it poses a massive structural weight on the stock price.
Well, absolutely. A massive weight. And beyond the equity markets, there are severe geopolitical risks inherent in their entire business model.
Because they are a global network.
Exactly. Operating a global, decentralized communication network inherently makes the company a major player on the geopolitical stage. In late 2026, the Iranian government formally designated Starlink ground stations and regional network infrastructure as legitimate military targets.
And keeping our analysis perfectly impartial here regarding the international politics involved, the strict financial reality for the company is that operating in contested airspace forces massive, unexpected security spending.
Right. The costs just balloon.
It threatens to drastically elevate insurance premiums for their space-based assets. You are no longer just running a telecom network at that point. You are managing a geopolitical flashpoint that requires military-grade risk management.
And navigating those international flashpoints requires highly centralized decision-making, which brings us to the key man reality of their corporate governance.
Elon Musk.
Yes, Elon Musk has led the company since 2002. Currently, he holds 42% of the total equity. But through a Class B supervoting share structure, he controls approximately 82% of the aggregate voting power.
And his compensation structure is wildly unconventional, too. I mean, his base cash salary is a mere $54,080, a number that actually hasn't changed since 2019. His wealth generation is entirely tethered to these extreme long-term valuation milestones.
Yeah, he holds $1 billion performance-based restricted shares. And they only vest if the company hits targets like a $7.5 trillion market cap. Or, famously, the successful establishment of a Mars colony with 1 million inhabitants.
1 million people on Mars.
Yeah.
And because he holds 82% of the voting power, standard shareholder meetings are effectively just legal formalities.
Yeah.
Public shareholders and minority institutional investors have zero collective power to overrule him on capital allocation, or demand a shift in strategy, or, push for a quarterly dividend policy.
Not at all.
But I want to play devil's advocate here for a second, because this is exactly the kind of thing traditional finance hates, but tech investors absolutely love. I mean, if I am buying into this stock today, I want that insulated structure, don't I?
Well, it depends on your perspective, but yes, there's a strong argument for it.
Because Wall Street has a long history of ruining visionary companies by forcing CEOs to cut essential R&D just to hit a quarterly profit margin or to pay some 2% dividend. If his goal is to build a city on Mars and dominate general artificial intelligence, isn't shielding him from activist investors exactly how you achieve a trillion-dollar valuation in the first place?
There is definite validity to the idea that visionary engineering requires long-term capital protection. The risk, however, is the lack of recourse.
Right.
If the capital allocation goes completely off the rails, say, if billions are diverted to passion projects that yield absolutely no return on invested capital,
Right.
a minority shareholder is completely trapped in the passenger seat. You have no ability to grab the steering wheel.
Which makes pricing this stock feel nearly impossible. I mean, how does a professional investor actually assign a valuation to a company aiming for Mars while actively burning $70 billion a year on evaporating hardware?
It's causing a massive ideological battle across Wall Street right now between two very different types of investors. If we evaluate SPCX through the ruthless mathematical lens of deep value investing, using the strip standards pioneered by Benjamin Graham and Warren Buffett, the company fails almost every single metric.
Yeah, because deep value demands that you don't overpay for future speculative growth. You want to buy a business based on what it is actually earning today. They typically look for a price to earnings or a PE ratio of 15 or less.
And SPCX's PE ratio is negative 131.2 because they consistently post massive GAAP net losses.
Right. And value investors also look at the price to book ratio. Ideally, they want a multiple of 1.5 or less, but SPCX trades at nearly 20 times its book value.
Yes, and book value is a particularly problematic metric here anyway, because the book is filled with rapidly depreciating satellites and AI chips.
Exactly, the dissolving bricks. Deep value also requires consistent, positive free cash flow, which we already established is currently bleeding at negative $14.5 billion. They want to see a solid return on retained earnings, proving the company can compound its own profits.
But SpaceX has deeply negative cumulative retained earnings of negative $20.9 billion. Their historical growth hasn't been funded by internal compounding at all. It has been funded by continuously diluting equity and taking on massive amounts of debt.
But the most revealing metric in the deep values at AI research is the discounted cash flow, or DCF analysis. For those listening, this is a formula used to estimate the value of an investment based on its expected future cash flows. So if we strip away the highly speculative AI data center costs and look only at their core, stabilized Starlink and commercial space launch business, they generate a normalized free cash flow of about $2.5 billion.
Right. And if you run a nominal case DCF on just that core business, assuming they can magically compound that $2.5 billion at an incredible 12% every single year for a decade, the intrinsic value per share calculates out to exactly $5.45.
$5.45.
Yep. A spreadsheet looking strictly at the cash the business generates today says the stock is worth $5.45. Yet the broader market is happily trading it at $118.14.
That is a massive disconnect. But didn't deep value investors notoriously miss out on companies like Amazon for decades because they only looked at the current cash flow? I mean, they punished Amazon for aggressively reinvesting every dime of profit back into warehouses and logistics.
That is exactly the counterargument. Thematic growth investors like ARK Invest and Cathie Wood, who have been aggressively buying SPCX, are relying on that exact historical parallel. They were actively ignoring the current cash bleed, and the market isn't pricing SpaceX on today's satellite revenues. It is pricing the stock as a venture capital call option on a future where they hold a total orbital and AI compute monopoly. It is the ultimate story stock.
But the short sellers, on the other hand, have piled up a massive $24.6 billion bet against this company. They are utilizing that deep value framework, and they're arguing that the Amazon parallel is actually deeply flawed.
Because of the assets, right.
Exactly. Amazon built steel and concrete warehouses that lasted for decades. SpaceX is building satellites that burn up in 5 years, and AI chips that are obsolete in 3. If the physical scaling laws of AI break down, if the large language models stop getting exponentially better and fail to justify that $73 billion annualized capex, the entire narrative will shatter.
And if that happens, the valuation multiple will violently compress, and the deep value investors will be totally vindicated. Buying this stock means you aren't investing in a traditional business with predictable margins and a stable foundation. You are funding an empire's relentless, highly speculative expansion across both orbit and silicon.
Which leaves us with one incredibly provocative concept to mull over as we wrap up this deep dive. We've established that SpaceX possesses an unmatched orbital monopoly. They have unprecedented cost advantages through their closed-loop supply chain, and they have massive 92% revenue growth.
All true.
Yet, even with all of those distinct massive advantages, they are still heavily bleeding cash. struggling to organically fund the physical infrastructure required for the AI revolution.
Yeah, and that leads to a huge question. If a trillion-dollar conglomerate with SpaceX's sheer scale and engineering capability cannot organically fund the AI capex cycle without resorting to massive debt and equity dilution, I mean, what does that mean for every other tech company on Earth trying to play the exact same game?
That is the big question, right? Are we looking at a courageous space pioneer pushing the boundaries of human achievement? Or is SpaceX actually the ultimate canary in the coal mine for a global AI capex bubble? If the strongest, most vertically integrated foundation in the neighborhood is still evaporating under the sheer cost of AI compute, what does that say about everyone else's house? Thank you for joining us on this deep dive. Keep questioning the numbers behind the narratives, and we will see you next time.